You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp, the program for you out there, the basic retail trader who wants to learn how to incorporate options into his portfolio. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. And by the time you hear this program, listeners, we should have a new addition to said network, which is called Options Oddities, and we record it a little bit differently. We record it every day at 1:30 p.m. Central over on the TD Ameritrade platform, and we dive into some unusual activity, unusual options activity that's really catching our eye. We do a lot of that, obviously, on the website. We bring that to the show as well. So if you're a TD client, TD customer, and you want to join us live in the chat room every weekday at 1:30 p.m. Central in the Swim Lessons Room, we encourage you to do so. Of course, you can check it out after the fact on the network. Options Oddities coming soon to wherever you find this fine program and the rest of the fine programs on the Options Insider Radio Network. And one great place to find all of those programs is indeed our mobile app, available for iOS, Android, and the burgeoning Fire OS. You can find instantly all of your favorite programs on the network, stream them wherever you have bars on your phone. Maybe you want to download a few for offline listening. You can do that too. And you can even hit that question, that comment, that feedback tab and fire off a question to us here on the Options Bootcamp program or whichever program you favor here on the old network. Don't worry, we won't hold it against you. All right. And joining me on the old program today, the old Options Bootcamp drill instructor squad, is my usual partner in crime, Mr. Dan Passarelli, the founder of Market Taker Mentoring. Mr. P, welcome back to the program. I hope you have your black hat and your whistle in tow, sir.
Oh, I sure do. I'm always glad to be back, Mark. We've got lots of fun and important things to talk about today.
We have lots of camps to be booted today. All right. And with the bad puns out of the way, let's dive right into it. You know, we were talking about what to do and what to talk about here, and then you guys had a lot of great suggestions, a lot of great questions, so we thought, what better thing to do with this episode than devote it to you guys? So we're going to dive right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, it always feels like the 4th of July on this show whenever we kick off the old mail call. Very festive, very patriotic music. All right, and kicking off the mail call here today, we have a question from a listener, Neil Filasco. And he writes, what steps do you recommend to hedge my retirement accounts, including my defined contribution plans? The pickings in these accounts are relatively slim, and there are no options to speak of. As one of the newly enlightened options masses, I thank you for bringing me into the fold, Neil. Well, Neil, you're welcome for bringing you into the fold or the dark side, depending on your point of view. And this is the question we get a lot here on the network. And first off, I recommend for you to dive into, we did a whole episode on this. It was episode 25, came out July 3rd of last year. It's called Using Options in Retirement Accounts. So I definitely encourage you to start there. We spent a whole hour on that. But that said, there are some tidbits, some highlights we want to address here. This is an ever-evolving part of the space, and a very frequent question, a very common one right now, actually, is the markets are rallying, and everyone's sitting on probably some gains in their portfolios. Not a bad problem to have. But they're kind of wondering, hey, what do I do with these things, particularly these accounts that are a little bit more restricted, a little bit more difficult to do the active hedging. It's easy to go hedge a position in your trading account. That's what it's for. But in some of these other accounts, things get a little bit more arcane. You have to deal with a little bit more minutia. You may even be told by some of these account holders that you can't hedge, which is a crazy thing, but that exists as well. So there's a lot of hurdles to overcome when you're doing this. So Dan, when you have a mentee or a client come to you, I'm sure you have a lot of them who do, with this exact question, where do you start them off?
Well, it depends on the unique situation. I mean, options are definitely not one size fits all. It's not, if the answer to that question was, you should do this, and then the conversation was over, well, we wouldn't have a radio show and I wouldn't have a education company, It depends on what assets are in your account. It depends on exactly what the rules are set up within your IRA. I mean, what comes to mind is a collar type situation if you're hedging something like an ETF or an individual stock. If you have a large portfolio with many, many individual stocks, you can probably hedge that with something like the Spiders ETF collar, possibly some sort of SPX trade, maybe a long put, depending on the situation. I mean, what you really need to do is you need to start out, of course, with some sort of basic understanding of options, and definitely not start using them until you really understand what you're doing. And then second of all, take a look at what you have, set some goals, set some risk limits, and then, we can construct an options plan that helps you meet those goals and helps you limit your risk in a very defined way.
Yeah, it's a difficult problem. A lot of people have this issue when they have these accounts because usually they have, like I said, one trading account somewhere, and then they perhaps have another defined contribution plan or something like that, and they have issues with how to hedge that. And so first off, I would definitely contact your plan provider and see what they have available for hedging options. You're probably going to get some blank stares or some blank moments on the phone if you do that. So your next step is probably to have to figure it out yourself. If you can go into your account, if you have a straight up IRA, for example, you can just buy a put in an IRA. That's easily done, and then we recommend you do that. And you can even do collars. We've talked about that before in an IRA account. So there are some strategies you can do in an IRA. Those are pretty easy, pretty straightforward. Beyond that, some of these more esoteric things, these 401ks, defined contributions, where you're limited in your trading selection, you may have to do a little bit more work. First off, you have to figure out exactly what you have in there and then what it correlates to. Typically, you're going to have a lot of probably large individual names, so probably it's going to correlate probably to the S&P 500, but it could be some other index, could be the Russell, it could be something else, the NASDAQ, depending on what the mix is that you have in there. And typically, your broker may have some tools or your fund provider may have some tools to help you do that. If you don't, I encourage you to contact them, because what you want to try to find out is your beta, really, what your beta is, how much you correlate to a particular index. Once you have that in hand, you can go out in your trading account or some other account and buy puts, essentially, on that number of shares of that index. If it's SPY, for example, if you own the equivalent in your portfolio of, let's say, 500 shares of SPY, you can go in and buy 5 puts on SPY and you're good to go. So it's a bit of a workaround. It's a bit of a convoluted process. It's certainly not ideal. There's also the psychological factor of essentially setting aside a portion of your trading account solely to devote to hedging these other accounts. So that if all goes well, that portion of your trading account is always going to lose, and it's going to be constantly dwindling. So that's a bit of a downer for some people to have to deal with. But that said, you don't want to be the guy who's just out there flying high with your defined contribution, whatever type of plan it is, and just riding the vagaries of the market up and down. If you can make some proactive steps to hedge that, then you should. That said, if you're just worried about a very near-term correction, and this is very long-term money, you still got 20, 30 years of sitting on it, those aren't that big of a deal. But if you're worried about a 2008, 2009 type scenario where the market gets cut by a third or more, then that's something you want to hedge against. That's something you probably want to be proactive about. So bad news here, Neil. It's going to take a bit of work. It's going to be a lot of issues, but on the flip side, it can be rewarding, particularly in scenarios like 08 or 09. And Dan, you want to chime in with a little bit more here?
Yeah, I mean, options provide the tool for you. You know, they are the tool. But you know, there's two things: just learning how to use those tools. And you know, if you're listening to me and Mark, kind of warn you, hey, listen, you got to know what you're doing first. I mean, don't take that as, hey, I should be intimidated, and hey, I better not do this. You know, you're responsible for your own money. Your broker, I mean, they want you to be successful, but I mean, if you're in a self-directed brokerage account, I mean, you're the guy who's responsible. And even if you are using a full-service broker who gives you some advice, still your money. You still got to look out for yourself. So, I highly encourage you to, you know, learn, know what you're doing, take a class, read a book, that sort of thing. And also, if your broker doesn't enable you to use the tools that can protect you, you know, I mean, truth be told, it might be time to shop around and get a new broker who might be able to enable you to protect yourself.
Yeah, you know, the good news, if you're with a big firm like a Schwab, they obviously have an option subsidiary in OX, so they'll be more conducive, I think, to having this conversation with you. Some big firms like Fidelity, where a lot of people have their retirement assets, not so much on the options side, so you may have a little bit more difficult road to hoe there. So it really depends on the firm and what allocations and assets they have. Hopefully, if you call up and you ask about hedging, they don't know what the heck you're talking about, you know, ask to say, hey, can I talk to someone over there who is involved with options? Or maybe if they have an options desk, and most of these big houses will have somebody who should be conversant on this topic that they can forward you to. And perhaps that guy could perhaps walk you through a better scenario. But yeah, but step one, find your correlation. And then step two, go from there. Whether you can hedge it in the direct account, probably not. You're probably going to have to make a secondary account or use your trading account and use all the techniques we talked about here on this show. You know, protective puts, put spreads, collars, all that fun stuff to great effect in these other accounts, because you do want to hedge these at the end of the day. It's not just free money. You want riding high with the market. All right, great question, Neil. Again, anyone who has questions like this, I encourage you, check out our archives, because we do have quite a few shows here in the archives, and chances are we've probably gone on at length about a topic you may be interested in. So go check out the archives. It's all in there, what we've talked about, and you can spend a whole hour listening to us break down the various steps and solutions. In this case, it was episode 25 from July 3rd of 2013. All right. Great question. Moving on, we have another one from Chandra. He writes, hey, Mark, love the radio show. I find myself wanting the next show because I learn something new every episode. My question is, how should a trader handle stop losses on a naked call or put and or a vertical spread? When should you call it quits? IBD mentions 8% for stocks, but what is the level for options? Thanks, Chandra B. Great question. You know, those types of barometers of, you know, X% to stop yourself out, a little bit different game in options than you're going to be with stocks. And stocks, if your position retreats 8% and you want to cut it, that makes sense. There's some logic to that. Options, a bit of a different game. For example, if you're buying positions, you're buying premium, you know those are going to decay. And you know going into that ahead of time, you're probably going to have some decay before the position works your way. So if you clip every position as soon as it decays 8%, you're probably going to cut yourself out very soon after you've bought those positions. So something to be cognizant of. Again, that's why we say on this show to always try to do mitigated type positions like spreads, where you're not having as dramatic of an outlay as if you're buying an outright call or an outright put or something like a straddle outright, something like that. It's going to decay a lot in your face. So you're going to have to be a little bit more flexible with these levels. Same thing if you're writing premium, you're collecting premium. If you sell options and take on all that risk and you let it just decay 8% and then buy it back, you're probably not even going to cover your commissions at the end of the day, because the amount of money, the amount of contracts you're actually moving is probably not going to be that much to profit substantially off of an 8% trade at the end of the day. So you have to look for a little bit more flexibility, I would encourage you, in your levels than just 8%. Mr. Passarelli, what do you tell your students, your clients, your mentees when they come to you with this stop me out type question?
Yeah, I mean, I'll answer this question two ways. The very simple way, I agree with Mark.
Can I just encourage you? That's a good way to answer all questions in life, I think. What would Mark do? WWMD.
And what I'll do is I'll kind of give a little bit of a longer-winded answer as to why I agree with Mark, and kind of support some things he's saying and introduce some things to think about. I think when people first get started in options, they look at them as like, oh, stock goes up, calls go up, stock goes down, calls go down. Okay, I get it. Leverage substitute for the stock, or, you know, doing selling, I can work in time decay somewhat, but you know, you really, really have to think about all the factors that affect the value of the options: volatility, time, and direction. And stops only work for direction. So let me work backwards here with your question. I'm reading this as well. With vertical spreads, you hedge off a whole lot of the directional sensitivity, and time becomes a much more important part of trading vertical spreads. For example, when you're close to the long strike, time decay works against you. When you're close to the short strike, time decay works in your favor, and that's whether it's a debit spread or a credit spread. So, I say with vertical spreads, you really can't use a proper stop. You kind of have to have sort of a different plan that encompasses these things. And one way to look at that, even with, and I'm kind of introducing long options to this like Mark did before I get to the naked ones, even if I buy a call, the reason why, putting some words into Mark's mouth here, the reason why I think Mark said, hey, you have to look at this differently because 8% is such a small, amount that it might not cover your commissions. You have to consider a few things. One is the delta of a call or a put. If the stock moves $1 and it's only a 30 delta, you're only going to make or lose 30 cents. So, you basically set up your option trade based on support and resistance and technical analysis of the underlying stock, but that underlying stock can move a lot before you make or lose money. So, that kind of throws off the whole using a stop. Also, the bid-ask spread can throw off using a stop as well, because if the bid-ask spread is 30 cents wide and your delta is 30, the stock can move against you, $1 and it moves 30 cents and there you go. The bid just became the offer sort of a thing. So you really, really need to look at stops differently. Now, one other thing. Everybody, when you are using long options, everybody loves the idea that, hey, man, I can have a leveraged profit here. Instead of buying a $100 stock and pay 10 grand for 100 shares, I can control that for $500 by buying a call for $5. And then, wham, I can make 100% or something if it goes my way pretty easily. But then, looking for, well, I'm going to cut my losses at 8% becomes not really realistic. So I think it's very fair to require you to accept a little bit of a bigger loss because your profits will be so much more leveraged as well. It's just sort of a different game in that regard. Now, I told you guys, I warned you this is going to be somewhat long-winded. I'm almost done. As far as naked calls and naked puts, I've got an excellent solution there. Don't trade them. Your broker margins the heck out of you when you trade naked calls because they don't really want you to trade naked calls, because they know that is the absolute riskiest position you can put on, and sooner or later you're going to blow up and lose your entire account. And they don't want you to do that because then you stop paying them commissions. And if you lose more than what's in your account, which is possible, then they're on the hook and you get a margin call and you go to arbitration, and nobody wants that. So, naked calls, that's just option trading 101. Just don't trade them. Trade a call credit spread instead. Trade 2 call credit spreads instead of 1 naked call. You have the exact same profit potential maybe with a fraction of the risk. And naked puts, that's always the rub. That's always the argument. If you're an investor, it's okay to trade cash secured puts. But if you're just a trader, trying to make some money because you don't think it's going to fall, trade put spreads there as well. You have way less risk and you can structure it by trading a few more contracts to have the same profit potential.
Good stuff, Mr. P. This is why we do this show, guys, is because options and stocks, not the same thing. They're related, but you can't really use the same analysis, the same levels that you would when trading stocks, when trading options. It's not the same beast. It is apples to gorillas, and sometimes people get lost in the middle. Again, that's why we do this show. We love to hear questions like that from you guys. Great question. Next question comes in from a listener, goes by the handle Hedger. He writes, I'm a bit flummoxed when it comes to spreads. I listen to a show like this that tells me to use spreads. I read a few articles about spreads, and I think I have the gist of it. Let's say ABC is trading for $50. If I think it's going to $55, I can buy the 50-55 spread for $1. I'm guessing these are his made-up numbers, listeners. He goes on to say, if the underlying moves to $55, that spread should be worth the maximum profit of $5. However, in the real world, my experience has been much different. In the real world, that spread would be trading probably around $2.50 or $3 forever. with exclamation points. If I hold the spread to expiration and all other things hold constant, I may, in quotations here, get my $5, but that's hardly a given. I guess I'm asking, what gives with spreads? Well, good question, Mr. Hedger. Hyperbole aside, obviously not going to be trading $2.50 forever. We'll go to $5. But this is a good point. People raise this a lot. They come to options. And again, this is why we talk on the show about the limitations of the traditional methods of options education, like looking at a expiration graph. Because that's how people usually explain positions. Here's an expiration graph for a covered call. Here's an expiration graph for a long put. Here's how it looks when you buy it. Here's your outlay. Here's how it looks at expiration. So people see that, and they see a vertical spread or whatever spread graph they're looking at, and they say, oh, here's how it looks. Here's my outlay. Here's my max profit. Here's my max loss. And they fixate on that max profit because that's the most they could make. And they go into that trade thinking that's what they want to make. That's what they're going to make on that spread. And the reality is quite different, as our friend Mr. Hedger puts here in very, very colorful language. The truth is, like we talked about in the show before, there are things at options like time decay and like the Greeks, delta, gamma, theta, vega, and all these things have to be taken into consideration when you're doing trades like this. For example, this spread is going to move, but you're not going to go straight, even if it is, in his scenario, at the $55 point, the maximum profit point. If this spread still has a month or more to go or a few weeks to go, guess what? You're not going to be trading for $5 because both of those options still have value. They still have some extrinsic value. Remember, we talked about that before, listeners. Intrinsic value being essentially the in-the-money portion of the value, the extrinsic value being everything else. The time value, the volatility premium, all the other gunk that gets stuck on top of an options pricing. And that stuff still exists, even if the spread is at its quote-unquote max profit point. So in a scenario like this, if the underlying does gap up to 55, let's say, he's correct. It's not going to be trading at $5 right away. It's going to take time for that. It's going to take time, and you have to wait until that decay kicks in. If it's in the scenario where it's hovering at the short strike, that's actually a decent thing for you because you're at the point then where your short options are the at-the-money strike. They're going to be decaying the fastest. Remember, time decay occurs the fastest in the at-the-money strikes there in the front month. So if you're sitting there at the short strike, on the at-the-money of your short strike, and that spread is going to be decaying faster, that spread is going to widen out faster than it may otherwise do. But at the end of the day, you're still going to have to wait a little bit. And that's kind of the trade-off people have to make when you're trading spreads. And that's why we say on the show and other shows on this network, when you're putting on spreads or any other position, you want to have a realistic estimation of what your profit potential could be. This max profit of $5, that is theoretically true, but you're going to have to hold it essentially almost all the way to expiration. And a lot can happen in between now and expiration when you're putting on a spread. So if a spread gaps your way, the underlying gaps your way, and you're sitting on 65, 70, 75, maybe 80% of your max profit potential, and you have to wait another 3 weeks or a month to get all the rest, the remaining 20%, probably a good scenario. You want to take that spread off. You've gotten what you wanted out of it, and now look to put something else on. There's an opportunity cost, of course, to sitting there for another month. You're missing other trades. So when you're putting these spreads on, that's why I say, again, look away from the expiration graphs. Look towards more realistic sources of education like this show and like what Dan teaches over there, because we'll tell you straight up that that's not going to happen unless you have that spread go to expiration. At the end of the day, how many options trades really go to expiration? Very, very few. So when you're looking at options, when you're looking at your max profit, maximum loss, you really want to factor in what's going to happen in the midterm and have some reasonable profit estimation, not 100%, because you're not going to do it. Same thing on the short side, too. We say this on the show a lot. This is kind of the flip side of that, where if you're shorting options and they're decaying, and all of a sudden maybe they decay pretty quickly, and now you're still sitting, you have to go another, let's say, 2 weeks or so to get that last dime out of that option, and you've already collected 60 cents or whatever, 50 cents, go ahead and close it out. You're not gaining anything but sit there for another dime. It's a psychological factor. You know it's going to go worthless, so it's kind of hard to pay that money. But at the end of the day, it's just not worth it. There's so many other risks, and you also have the opportunity cost. You're missing other trades by sitting on that money. So go ahead, close it out. All right, Mr. P, what do you have to say here for our friend, Mr. Hedger?
Think of it like buying a stock, right? If you buy a stock, your maximum profit potential is infinity. Are you going to hold on to it until you get infinity? No. At some point, you say, hey, you know what? I like the profit that I got here. I don't think it's worth holding on to this anymore. I'm going to cash out. You do the same thing with options. I mean, from my personal experience, I almost never hold anything until expiration, and I mean, I've been doing this a long time, and candidly, the reason why I don't hold anything until expiration is because when I first started in my trading career, I did hold things until expiration and had it not work out. Really got spanked pretty good. And so, I learned my lesson. The goal isn't to reach your maximum profit. The goal is to make money as a trader. So, my rule of thumb, especially with vertical spreads, if you can take 75% of your maximum profit, take it. Definitely. And look at statistics too. It's a small percentage of trades. It's like 25% or something of trades that actually are held until expiration. And that's because, sooner or later people figure it out. It's a kind of a fool's errand to try and wait until you get your max profit.
And that's why you love expiration graphs so much over there at Market Taker, right?
Yeah, that's why I wrote a book, Trading Option Greeks.
All right, great question there, Mr. Hedger. Next up, we have a question from a listener who goes by the handle Toothfish. He writes, option question for Options Bootcamp. Well, good. Got the right show. Long or short. Hey, Mark, and the Black Hat one. So, Dan, I guess that's you.
Right.
You're the Black Hat one. Loving the Bootcamp show. Well, glad to hear it. Why is it back to once a month? Should be daily. Well, yeah, that's a long story there, Mr. Toothfish. A lot going on, particularly on a long-running show like this. But, a show that's been running for a long time, we like to freshen it up and find new people, new sponsors to come talk to you guys on these shows like this. So that's we're in the process of doing that right now, and that's why the show is kind of at once a month till we get everything sorted out. Of course, the network's pretty busy right now, too. A lot of other shows going around. But don't worry, we'll get Bootcamp back in your podcast player many more times a month very soon once we get everything else sorted out and once Dan and my schedules clear up a little bit so we can actually get into the groove a little bit more. All right, he goes on to write, anyway, I've heard you guys bicker back and forth on dark side versus light side trading, but I don't think you've ever actually committed to one or the other. So gun to your head, which way are you going? Premium selling or premium buying? And Dan, since you are the proverbial black hat one, I shall let you have pride of place on this one, sir.
Well, interesting question, Toothfish, and I've heard this question posed, 1,000 times, probably 10,000 times in my trading career, and talked about among professional traders, academics, and just everyday Joe traders as well. And the answer is, it's not the right question. Because they serve different purposes. That's like saying, hey, I'm driving my car. When I turn right, it's kind of easier because, I don't have to worry about the left oncoming traffic. I just need to worry about who's coming, in this one lane, Although if I turn left, blah, 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 I don't know, whatever. Sometimes I need to go right and sometimes I need to go left. There's not a right answer there and there's not a right answer here. In not even trading, forget about options, forget about trading. Just think of trying to make money in something like business, selling, apples or something. You buy things when they are cheap. You sell things when they are expensive. That's how business works. Buy low, sell high. So when options are cheap, you buy them. You don't sell them. You don't put on income trades. When options are expensive, you sell them by putting on income trades. You don't buy them. And that's the pure answer. That's the simplified answer. We could do 10 shows on this subject and really talk about how implied volatility is calculated and whether it should be end of day or intraday and take in, the daily range and, 5-day week, 7-day week. And we could really do some real nerd math about this. But in the end, the answer is still going to be the same. If all you do is one type of strategy, all you do is sell options, in the long run, it's not going to work because when you go into periods where options are really, really cheap, you're playing a bad game. You're basically being an insurance company when the risk is when your premiums are not high enough to compensate for the risk. So the answer is you need to do both.
That said, sell everything, right?
Right.
Now I know you guys don't love it when we give the political answer, but sometimes that's the right answer. It's the truth. You don't come into anything with one fixed way of doing it. You have to be adaptive to the market environment. And that's the way you have to trade options as well. You know, a lot of us on the show, we talk about spreads all the time. We have to have mitigated outlays for whatever we're doing. So regardless which way we are, we're going to go mitigated with a spread. And sometimes it's selling, sometimes it's buying. There are some guys, if you listen to our old Values program with Don Schlesinger, who was diehard sell only options, don't never buy them. Options die a little bit every day and all that fun stuff. So there are some guys who believe in that implied premium over realized volatility and think that's crazy and think you should be selling it rather than buying it. So there certainly are people who are devotees of each side, but a lot of people tend to fall in the middle and they choose a strategy that works best for them in the given environment. And that's the way we like to lean here on the show, Mr. Toothfish. All right. Next up, we got a bit of an interesting question here. I like this one, Dan. This is from ING86, and he or she writes, cool show, learning a lot from all the options talk about XYZ and Apple, two of my favorite underlyings. I don't know about you, Dan. But what are some of the crazier things I can trade with options? Can I trade options on a big Hollywood premiere? For instance, I would have loved to be long calls on the Ninja Turtles or the Guardians of the Galaxy. I like that. I probably would have liked to be that too. What about sporting events or elections? I think this would be fertile trading ground for these products. Can I do something like this, or is this too outlandish? This is a great question, Mr. and Mrs. ING, because I often think it would be fun to have some of these more mainstream type products to be tradable by the public. It might be a good way for them to get some entree into the world of options if they could look at something like exactly what you said, like let's say a movie premiere or a sporting event, something that they're going to watch anyway and have an inherent fundamental understanding of. If they could come and now trade options on it, that would be great. That would be a great way for them to kind of learn the fundamentals in a fun, informal, easier to understand way than perhaps all the jargon and minutia they get hit with when they come to options. You know, Dan, I don't know about you, when I was on the floor, I used to sling a lot of movie futures. I used to be known, actually, on the SIBO floor as the guy you would go to make markets on movie premieres, just like this. I wouldn't do options, obviously, because then you're talking lots of series and lots of classes I have to maintain markets on. But I would do the underlying. I would make a futures market on a premiere, and we would trade around them. We'd trade all kinds of stuff like that. It was pretty fun. You make a market with one guy, you buy futures here, you sell them there, you lock in some profits. It was kind of fun. It was applying what we do every day to movies. And I actually thought for a while there to try to find some way to codify that into some sort of real legitimate trading platform. I looked into it. It's a pretty difficult road to hoe. And, of course, things like movie premieres are also not exactly quantifiable, not hard to get really good contract specs on that. A lot can go into that. That could be gamed at the last second. They could cut down the number of screens. Some guy could screw with the print at the last minute. A million things could happen that someone could use to game the system. And meanwhile, they're long a bunch of puts on, let's say, Ninja Turtles, and they're rolling in it because some line producer screwed up the distribution, whatever the case may be. So I think people like Cantor Fitz have looked into this too. They tried to make a legitimate version of this. I don't think that ever really went anywhere. Of course, there was the Hollywood Stock Exchange. I believe they had options on there as well, but none of them ever really were legit trading contracts. Have you ever had any forays into the other dark side, Dan? Some of these more perhaps crazy products you've ever wanted to trade?
Yeah, I mean, there are stuff out there like wine futures and that kind of thing. You know, I mean, you don't get the liquidity there when it comes to that. I mean, when you're talking about a stock like Apple or something like that, where you've got, you know, a gazillion shares and a gazillion people trading them, I mean, you get the liquidity. But, you know, how many people really care enough about the Ninja Turtles to have a contract based on it?
I don't know how much money they make this last weekend, like $70 million. There's a few people.
Yeah, but I'll tell you what, though. Truth be told, you can use conventional options to trade a lot of these things that we're talking about here. And I've done this with certain clients. And I'll tell you what, in fact, I actually am currently working with someone on movie releases on how to trade those. There is a very specific way to go about doing it, and you can do it. She's had some success with it so far. As far as elections go, you know, trading the broad market and really understanding how the market will react if this guy's elected versus if that guy's elected, people trade that. The sporting events, I don't know about that. I worked with another guy in one-on-one coaching who was an expert in, like, electronic media, things like TiVo and the Amazon stuff like that, and Apple TV products, and like all this like very new modern ways to watch media and that kind of thing. Like, he was an expert in that. That's what he did with his career the whole time. And so he had more insight. And I'm not talking like inside information. I'm just talking about like, you understand how the business works. And so he was able to trade that stuff in a way that a typical person couldn't, because he understood that market so much better. And so he would look at like, hey, you know, Amazon's got this new streaming product coming out. You know, how should we trade this? So, I mean, bottom line is, yeah, I mean, maybe there's not direct contracts out there like how many people are going to go to opening day of Ninja Turtles, but you can still trade it if you really understand it really well.
You know, I'm just looking here while you're talking, because I know Cantor Fitz was looking into this pretty aggressively, and they were one of the few people I saw to actually try to tackle this problem of, you know, commoditizing movies and how to do it. And they were approved by the CFTC for a, what do they call it here? The domestic box office receipt futures contracts, also known as movie box office contracts. They anticipated them to launch in the third quarter of 2009. Of course, we're talking about this now mid-2014, and we haven't seen hide nor hair of them, so it didn't really work out. And what turns out, listeners, is about a year later, in the middle of June, of course, we're post-08-09 meltdown, a lot of financial reform regulation coming in. And it's interesting, apparently the MPA and a few others lobbied aggressively on the Hill to include some clauses in their financial reform that would specifically prohibit movie futures. So they wanted to insert a box office futures ban in the original bill that they were putting out, the Democrat Senator of Arizona was putting out, and they did. And so that persuaded firms like Cantor Fitz and others to back off. There was another one called the Media Derivatives. They were thinking about doing it as well. They both got CFTC approval back in 2009 or 2010, and yet for whatever reason it fell apart. So yeah, I guess now if you want to trade movie openings, call up Dan.
Yeah. Well, I mean, if there are listeners who, I mean, you're an expert in a particular field, like pharmaceuticals is a perfect example too. I mean, I advise typical people just to not trade small pharmaceutical companies that don't have a portfolio of drugs who are in their first drug trials. Like, you are going to lose money, because the people who make money are the people who are experts on that and know when the trial dates are and what the percentage of, you know, the trial going through are and what the value of the company is going to be if it does go through versus if it doesn't go through. Like, you know, different people have different sets of expertise. And when you do have an expertise in an area, I mean, it can make you a better trader because you understand it better. You know, I mean, it's kind of simple and obvious, but.
And just think how fun it would be to do a movie option show here on the network. That would be great. I would love that. That would be fun. We could talk about slinging around premieres. It would be huge. All right. Next up here on the old mail call palooza, we have a question from Chili Palmer. I'm guessing that's a handle. I think that's the character from one of those Elmore Leonard movies, I believe. He writes, confused on takeovers. Hey, Drill Squad, help me out with takeovers. Let's say I bought calls on firm A and then firm B buys them out, something I'm dealing with right now. He puts in parentheses, what happens to my calls on firm A? That firm is going away and the stock will no longer trade. Will my calls be automatically exercised for me on the day the merger is put through? Should I just sell them now rather than wait for the issue to be settled? Thanks, Chili P. Well, Mr. Chili P, great question. Dan, I'm sure in your mentee experience you've run into this one once or twice. What do you tell people with this particular question down there at Market Taker?
Well, first of all, if you're trading takeovers, you know, typically the way people trade takeovers is they hear some sort of a rumor and then they buy calls and blah, blah, blah. Just a little bit of a caution, that's not the best way to do it. Because once there's a rumor, the implied volatility in the calls gets jacked up really, really high. And then half the time, even if the deal does go through, the implied volatility collapses and you still end up losing money on your calls. So the best way to trade takeovers is by using a vertical spread, like a bull call spread, because you can hedge off the volatility risk. There's a little bit of an art to that. There's a couple nuances that, you know, you need to know, but that's the gist of it. Now, as far as when there's a corporate action, whether that's a takeover or a spinoff or a cash distribution or a bankruptcy, or, you know, like an unusual dividend, here's what you do. It could be a number of things that happen. And depending on, like, in the takeover, what the deal is, like, is it a cash deal? Is it Is it a stock deal? Is it a combination thereof? It can be really, really complicated. With a cash deal, what happens is expiration day comes early for you. On the X date of when the cash deal goes through, your calls expire. I mean, you might have a call that expires in December, but if the X date of the deal goes through on October 15th, your calls expire on October 15th. So all your time premium disappears, it can hugely affect your profit and your expectations. What I advise you to do always is call the Options Clearing Corporation. Their phone number is 888-OPTIONS. Not hard to remember. Write it down anyway, 888-OPTIONS, because they are the official source. They decide on how the options are handled. And they can be handled different ways. In my trading career, I've had a couple of really doozies that ended up being really, really complicated. And if you don't fully know exactly how the OCC is handling them, you can end up in a lot of trouble.
Yeah, OCC is the place to go for all of that info. You can call them. You can go to optionsclearing.com is the other place you can go for that info. And usually if there is a corporate action, they will have some sort of circular on it explaining exactly this, what they're going to do to these particular issues, how it's going to be adjusted, that sort of thing. So that should be your first stop. Surf on over to OCC and ask them, or search for your ticker on their site. There's a little search bar up the top. You can type your ticker in, and they'll probably have a circular announcing this corporate action and what will happen as a result. Those are the guys to talk to, because they are the ones who make the decision at the end of the day. Not your broker, not the company. It's OCC who handles the options, symbology, and all that fun stuff therein. That said, if you can't find something or you're still confused, call your broker. That's obviously the second step you want to go. They're the ones handling your accounts. They should have some knowledge, and if not, they'll have someone there who should be able to find it. They might have to elevate you a little bit to a couple of different help desks, but they should have someone there who can walk you through it, or perhaps give you a little bit more information. And those two will usually be the best sources for this sort of thing. And if you are confused at the end of the day, you should really just close it out. If you're kind of worried about this thing not working out and you have no idea what's going on, you should really work it out. Now, you mentioned them kind of shutting down the options a little bit earlier. And my impression, Dan, was that OCC wouldn't force a taxable event, that they would allow those products to remain. It may be a completely illiquid product, but they would still be listed until expiration. Are you saying you think they will come in and shut down a product?
In a cash takeover deal, I have seen that happen, yeah. And, that can have a huge effect. Yeah, tax stuff probably, but, if you're long options, you're using basically your pricing model and trading your option premium based on, this is going to expire in 3 months. But no, your theta just automatically speeds up and becomes huge because your expiration date effectively moves. So, yeah, it's a huge deal.
Actually, that's true. Cash is a bit of a different beast because you're not swapping shares for one with shares of the other. In those scenarios, you're right. They're not going to force a taxable event. You're going to be, translated into some other thing. And your options, even though that firm no longer trades, will still be listed. They will still exist until expiration. But you're right. In a cash deal where there really is no more of underlying of company A and there's no more liquidity to it or anything, that's a little bit of a different beast. So, again, at the end of the day, the best solution to all this, contact OCC. And they will walk you through that fun stuff. We have time for, let's see. Last up, we have a question from a listener who goes by the handle Sivas, I suppose you pronounce that. This is kind of similar to what we were talking about earlier. He writes, what is the best way to handle a ratio vertical spread that has moved to my short strike? Close it out as soon as it hits the short strike, even though that means buying back 2 options on the short strike for every one I sell. Play the wait and see game to see if the underlying retreats and those short options go out worthless, or add a long premium third leg to my trade to cap my risk, essentially legging into a short iron butterfly. I know Mark is partial to those. Well, that's true, I am. Enjoy the program and enjoying the app. Thanks for all the shows and the mad knowledge. Sivas. Well, thank you for that. Thanks for all the love there, Mr. Sivas. Dan, kind of anecdotal to what we were talking about earlier with managing spreads, but in this particular scenario, he's got a very specific spread in mind. That's the 1x2, long 1, short 2. We like that spread, but can be a little bit risky. What do you recommend to your mentees, your clients, when the quote-unquote worst, not really the worst, but approaching the worst comes to pass and the underlying, let's say, gaps up to that short 2 strike and then kind of sits there?
Well, I won't say play the wait and see game, because, to me, playing the wait and see game implies, hey, I don't have a plan. I'm just kind of winging it and I hope it works out. But you do have to wait some, because then this trade becomes not a directional trade like you think of it when you draw out the profit and loss diagram, but it becomes a pure theta play because you're sitting at the short strike where there's two options, so it's more concentrated, so you make money based on your theta. So, I mean, these trades are a lot more complicated than just a vertical spread. It's not just like adding another call to it. I mean, it is mechanically, but you got to think about it a lot differently. It's very, very much not just a directional trade, but it's also a time play. That's how you make your money, by sitting and waiting and collecting theta. Now, to my original point, it's essential to have a plan going into this and say, okay, if the trade goes against me directionally, I know that, net, maybe my theta is going to be 0 or close to it if I'm down by the long strike. So it's kind of a pure directional thing, and I'll close it if the stock moves to here. If it goes my way, well, then I know that it's really no longer a directional trade. It's a theta trade, and so I'm going to close it when I reach, you don't really have well, I guess you do. You have a max profit potential on that trade. I'm going to close it when I get to 75% of my max profit potential, for example. So on any option trade, especially a trade like this where you have naked options, which again is not something I advise my students, it's essential to have a plan going into it, not just be like, oh, well, I guess profit's good enough now. I guess I'll take it. That doesn't work.
Yeah, this is exactly what we were talking about earlier. There has to be a little bit of time in the system because there's time decay. And when you're short those options, that has to work in your favor. So you want to let it go a little bit. If you just shut it off as soon as it moves in your favor, and you're right, you're buying back two relatively still expensive short options. And what's happening in the underlying is kind of exactly what you wanted. You wanted it to move to that max profit potential and then sit there. That's the ideal scenario for this trade. Of course, then it takes a little bit of waiting, a little bit of patience. Some people don't excel at that, but you want that max decay to kick in, let that spread widen out, let those two short contracts decay a bit, and then you take it off for whatever percentage of your profit you were looking for. Like Dan said, 75%. That's as good of a barometer as any. And again, this is a good idea, too, to have some sort of contingency plan in place. You don't want to just sit there willy-nilly twiddling your thumbs. So if you want to leg into that fly, that's an idea, or have some plan to take it off if the underlying continues to move a certain percentage past that short strike. Have some contingency plan there so you're ready to act in case the worst does come to pass while you're sitting there and collecting your theta. That's a nice thing to have sometimes. It's a bit of a good feeling. It could require some antacids to it as well, but at the end of the day, it's nice to be collecting money instead of paying money at the end of the day. Wouldn't you concur, Mr. Passarelli?
Yeah, actually. Absolutely, for sure, yeah.
All right. That's going to do it for the mail call. It's also going to do it for this episode of Options Bootcamp. I want to thank everybody who wrote in such great questions. Keep them coming. No shortage of ways for you guys to get in touch with us here on the old program. You can, of course, leave us a comment on the website, theoptionsinsider.com. It's kind of the mothership. You can find everything there, all the radio, all the other stuff. You can leave us comments for the shows. You can even use our website feedback form. I know a lot of you guys like to use that as well to submit questions. So be sure to put somewhere in the body or in the subject question for Bootcamp so we know where to direct your question. You can also find us on email, questions@theoptionsinsider.com, or find us via social media, twitter.com/options, facebook.com/theoptionsinsider. No shortage of ways for you guys to get in touch with us. Again, like I said, at the top of the show, all that also baked into the mobile app. So no shortage of ways for you guys to reach out and make your voices heard, just like a lot of your fellow listeners did today. And before we wrap up here, Mr. Passarelli, what's cooking, what's coming down the pike over there in the land of markettaker.com?
Oh, I don't remember if I mentioned this last time, but we completed a couple of free ebooks that are really, really great. And I've got an ebook on my site on using options to generate income. One of the things we talked about a little bit here in this show. And we're really, really happy with it. We'd love for you to come over to the website, markettaker.com, and get that free ebook. You can just click on one of the tabs across the top, and we'd love for you to check that out.
There it is, right on the top. It says Free Options ebook, listener. So surf on over, markettaker.com, click on that tab, and get some of Dan's wit and or wisdom. I won't promise the wit. There might be some wisdom in there, absolutely for free. And while you're checking out Dan's stuff, go check out Trading Options Greeks as well. You can find it on Amazon and wherever finer books are sold. And on behalf of Dan and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. and for downloading the app, and of course, for sending in such great questions. Keep those coming. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.